Hello investors, it's Stuart Cruz and welcome to Cruz Asset Management's video chart of the day. And today we're going to be using some templates that are provided by our friends at YCharts. Now what this template is, and probably many of you are familiar with this is a Morningstar Style Box. And across the top you have value, blend, and growth. And then down the side you have large cap, mid cap, and small cap. And what we notice right away is that value is all negative, all red, and growth is all green. So value has been considerably and significantly underperforming growth. But not only that, small caps are underperforming large caps, and mid caps are in the middle. Now, this traditionally doesn't make a lot of sense because what we've been taught, at least what I was taught in business school, was that the amount of risk you take equals the amount of reward. And small caps tend to be more risky, so you tend to be rewarded for that risk, or at least that's the theory. But that's not what we've seen for quite some time. Small caps are underperforming and large caps are doing well. Now, growth tends to be more risky, so you should get some more reward for growth, but not a 30% differential over year to date. And if we kind of go through the periods here, if I look at year to date, if I look out, let's say over a 1 year period, that looks just about as bad. Growth is still 35% outperforming value in the large cap space. And again, small caps are underperforming. If we go out 3 years, then it looks like the margins are narrowing a little bit. The differences are narrowing. And 5 years, they seem to be narrowing even a little bit more. Now, what does that mean? That means right now, or in the more recent times, year to date, value is significantly underperforming growth. And traditionally what we see is when there's that big of a disparity, there's some sort of regression or reversion back to the mean. And I'm going to make a little point here. I have up here another chart from YCharts. Here's a scatter plot, the 5-year total return, and the standard deviation, which is often looked at as a proxy for risk. And what I put up here are a bunch of Schwab ETFs. So here's the monthly standard deviation, and when you go out to the right, that indicates greater risk, and then going up this chart is greater return. So over here, the SCHZ, this is the bond portfolio. So a low amount of deviation, and what you would expect is a low amount of annualized risk. That makes a lot of sense. But what doesn't seem to jive, and what seems to be a disconnect, is traditionally what you see are, as you move up here with more risk, you should get more returns, almost on a straight line. But that's not what we see here. Right now, we have almost the same amount of risk between the value portfolio and the growth, but growth is crushing value. And even worse, you see moving out to the right, small caps are showing a lot more risk, but a lot less return. And then this is the international, which is again showing quite a bit of risk, but almost no returns. And REITs, which tend to not be that risky, which kind of generally fall in between bonds and stocks, are showing to be one of the more risky assets with the worst returns possible. So none of these kind of make sense. And whenever there are all these anomalies within the marketplace, there's generally a correction back to the mean, kind of a reversion back. So what I might expect to see is growth returns pull down, the standard deviation of real estate to drop, and or the returns to kind of move up. And some of these should probably shift up and to the left, so we have a little bit less risk or a little bit more return, one or the other. Okay, so that's what we have right now. And I wanted to show you this style box of a month to date, because we might be seeing the very beginnings of this. So I just switched to month to date. And what you see here is small caps outperforming large, and you even see value outperforming growth. And so I know it's early to tell, and it's only been 1 month, but trends have got to reverse at some point. And given that interest rates have been low for quite some time, that favors growth. And if you are anticipating there being some inflation, given all the Fed spending, rising interest rates would cause PE compression on some of these expensive tech stocks. And so that would probably show an indication or a rotation into value companies. So if you want to learn how to partake in that and participate in the rotation, Cruise Asset Management runs a QVP, quantitative value portfolio. I did a video chart of the day on Best Buy. You can certainly look it up. I'll include a link here that has outperformed a lot of tech companies on a 1, 3, and 5 year period. And so the quantitative value portfolio is a way to buy $1 of earnings at a cheaper price. We asked a very fundamental question: what characteristics of stocks tend to lead towards outperformance a year from that time? And let's buy those stocks today. So if you want to take advantage of this, what I think is going to be an impending value rotation out of growth, then check us out. Look at our schedule a time to talk to us about our QVP portfolio. And don't forget to invest with the odds in your favor.